stocks, as I just pointed out, are near the lows of the day. Investor sentiment tipping back toward fear, rising tensions in the Mideast from strong economic data here at home. Bond yields have been surging as the world waits on how Israel will retaliate against that unprecedented strike from Iran. Israel's military chief of staff saying there will be a response of some kind. Joining us now, Liz Young, SoFi head of investment strategy. Liz, thank you so much for being here. Obviously, a lot to sift through today. You've got the headlines coming from the Mideast. You have that stronger than expected economic data here. Oh, and by the way, it's also earnings season. So how are you thinking about all these issues?
There's a lot going on out there, and this day so far has been complete whiplash. We began it really with the relief of maybe not an escalated tension in the Middle East, and then gave all of that back pretty much when we found out that maybe it isn't over after all. So it's hard to argue that after last weekend things have gotten better, but we are heading into the busier part of earnings season where we'll get really the data from companies that the rubber hits the road. I think we're in a place right now in the market where we are priced for a pretty good environment. And that doesn't necessarily make that super risky, but what it does say is that earnings have to come through at least as strong as investors expect them to, if not stronger. And we've already seen with some of the banks that if guidance isn't as strong as investors want it to be, they've been punished. So if that theme persists throughout earnings season, the multiple on the S&P right now could be at risk.
And Liz, bring it back. I mean, geopolitics front and center today. And the world to a lot of folks, Liz, right now probably looks kind of fragile. And it's not just, Israel, Iran. It is Russia, Ukraine. It is China, Taiwan. It is Israel, Hamas. As a strategist, Liz, how do you think through these geopolitical tensions?
Yeah, I mean, it's difficult to step back and try to take just a purely investment take on it. But something that was going on even before the heightened risk over the weekend was that there was a lot of currency volatility. We have central banks around the globe starting to move in different directions, which just raises the risk of currency volatility, and it just raises the question marks. We have really big regions thinking about moving in different directions. We've got Japan on the upswing, we've got the US maybe at some point cutting rates, but that just it raises all of those bumps in the road in currencies. So that's first and foremost what I watch as a strategist. You also watch things like gold, which we know has been on an absolute surge this year, and commodities. And commodities and gold are something that are traded around the globe, and they're important to a lot of global nations in different ways. They're also important to inflation and the trajectory of inflation. And what we've seen, regardless of the fact that we've been seeing growth in inflation come down, we've seen commodities surge this year, which puts a lot of pressure, particularly on the Fed, to stay tighter and higher for longer. And that affects a lot of the globe as well.
Of course, markets have been dealing with the idea that the Fed might be on hold for longer. All things considered, relatively well, if you look at the equity market. When does that become more problematic, though? Or does it become more problematic? I mean, especially as we continue to see bond yields rise.
Well, I think that last part is what you just hit it on the head. As yields have risen, it seems like there was a threshold somewhere between 4.4 and 4.5 on the 10-year yield where stocks were no longer digesting it in a positive way. And now we've got the correlation between the 10-year yield and PEs turning negative again. We've got stocks going down as yields go up. And that is normally how the relationship works. Now, this doesn't necessarily mean that there's these huge alarm bells going off. This is, as we know, coming off the heels of a really, really strong rally that started at the end of last year. So giving a little bit back here because valuations seem a little frothy is not a bad thing, and I think would be very natural, even regardless of geopolitical risk. So this isn't something that's sending signals, even when you look at the internals of the market, it's not sending alarm signals yet that say things are really at risk. But I do think there needs to be some right sizing of stock valuations, given the idea that we've moved from 6 cuts to possibly 2 cuts this year, or the possibility of not having any cuts this year, and capital staying tighter and more expensive than we originally thought it might.
And Liz, on that possibility of no cuts this year, it's just interesting to see the number of strategists who are kind of coming around to that as their base case. Torsten Slok, Ed Yardeni. No cuts this year, Liz. Can the market still move higher?
if yields stay in check, I think the market can at least chug along for a while. So the period between the last hike and the first cut, the market usually does okay. It's that first cut and the reason for the first cut that can give the market a lot of trepidation. But this period in between can be okay, if not positive, for markets. We've already seen a lot of positivity. That's really the issue right now, is that we've seen a lot of the upside. Is that all we might get? And then we go through a sideways period absent bad news. Now, I don't know that we're not going to get bad news for the rest of the year. I think that the economy will slow a bit. Everybody is projecting that, just hoping that it only slows a little bit without completely freezing up. So if we don't get cuts this year and if yields stay in check, I think the stock market can do okay. And always remember, I know you guys remind people of this all the time too, a 10% correction happens every year on average, and that is an okay thing. So nothing to get too freaked out about in the near term, but we do need yields to lower the volatility, at least in the treasury market right now.
Liz, great to see you. Thanks so much.
Thank you.